Hello everyone, this is Corey with TradeThatSwing.com, and this is your stock market outlook for the week of June 5th. Every week I go through the same process. I just look through how the indices are doing, market health indicators, recent watch list and trade performance, and sector performance. That gives me my overall outlook for the market and helps me determine whether I'm going to be aggressively buying or shorting stocks, and then in those stocks, then I can look for the patterns and triggers. There's articles on each of those. This article is always usually on the first page of the website if you go to TradeThatSwing.com. I usually update a watch list which has stocks that I'm specifically watching. I haven't had time to update it recently, so it's not on here, but you can check out. This is a watch list for just stocks that are really strong, and it was updated toward the end of the month. So still some potential ones on there. Let's look at the indices. Overall, we can see NASDAQ still running away to the upside. Strong uptrend, no question there. In prior weeks, we had talked about this weaker uptrend in the S&P 500, making higher swing lows, higher swing highs, and we had stalled out here. Nice breakout this week, really nice to see. So these two are good. The NASDAQ composite, I would say it's in a downtrend. We had a lower swing low here relative to that one. We haven't fully recovered back up to those highs, but we did have a nice, really strong surge here. So it'll be interesting to see if this one can clear. You could draw a little trend line along the top of that. If it can clear above that, that'd be good and would indicate a short-term uptrend. We had this big rally here, a higher swing low, and then if we can start pushing up, that would indicate a short-term uptrend building toward these prior highs. The Russell 2000 small cap stocks, pretty weak overall. We were hanging out near the lows, but we did have a nice breakout this week above this range that had developed the last couple months. So also good to see. That'd be nice to see it continue to the upside, and then the next pullback stay outside this range, or if it dips a little bit into it, we definitely don't want it to take out these lows. The Canadian index, pretty much middle of a big range going back to late 2022, slightly expanding. You can see we made a slightly higher high here than here. Here we dropped right back to that low, went almost back to the high, and now we're just kind of hovering right in the middle. So not an uptrend, not a downtrend, just in the middle of a range. And I threw the Japan index on here simply because it's one of the strongest indexes of the year, strongest stock markets of the year. So this is EWJ, an ETF on the U.S. exchange, and you can see it's had a pretty nice run up in 2023. Gold weakening a little bit, and Bitcoin also struggling a little bit after this strong run up earlier in the year. So that's basically what we just discussed. We have a bit of a mixed bag, you could say. We have a lot of stocks that are doing well, but we also have a lot of stocks that are not performing well. So this is okay conditions. It is not ideal. And that's when I really want to be aggressive and making sure I'm deploying all my capital when all these, I'm not talking about gold and Bitcoin, but when these U.S. indices are all moving up, that's a really good time. Right now we have two of them moving up. Two of them kind of in a struggling spot, seeing if they can continue to push to the upside. So we're in good conditions. Not ideal if you're looking to deploy some capital, but I wouldn't be highly aggressive in this situation just yet. I always prefer to wait till conditions improve and then get heavily involved. So I do have some capital deployed right now, also because the health indicators have turned into the positive territory. We were sitting right on the cusp here for a long time. This was a really good sort of overall indicator of how the market was performing, and you can see we were flatlining on the S&P 500. This is how many stocks are above their 50-day moving average. It's a very crude measure of how many stocks are in an uptrend, and you can see we were hovering right around that 50% mark. So only half of stocks were above their 50-day moving average, half of them were below. And we're starting to push back upward. 57% of all U.S. stocks are above their 50-day moving average, and 51% of S&P 500 stocks. So that is moving into positive territory. That's a good thing. I also like this. This is the daily average movement of the S&P 500. You can see really big downside moves are synonymous with a bearish market or downtrending market. You can see big drops during all these declines. During uptrends, you do not get that as much. You have much smaller movement and you don't get these big drops. We have not had any 2% drops in a single day for a long time now. So I've given this one the thumbs up as well. It's in good shape. We're starting to see smaller movement compared to what we saw. Volatility is dropping. That's signs that people are becoming a little less scared. They're not dumping their shares as quickly when some bad news comes out or something. So this is good. The NYSE advanced decline line had been dropping while the S&P 500 was moving sideways and even edging up a little bit. So that wasn't a great sign, but we are starting to see the NYSE advanced decline line push up, make slightly higher swing highs. So this is good to see. So I would say this is confirming the indices right now, and also giving us another indication of what we talked about over here. We have some stocks that are doing well. We have some that are not. We can see the NYSE composite index, not doing quite as well as the NASDAQ or S&P 500. So seeing this struggle a little bit but turn up recently is good, but kind of based on what we had talked about in the indices, not super surprising. This is up volume versus total volume on the day. The amount of volume in stocks moving to the upside versus total volume for the day on the NYSE or New York Stock Exchange, and nothing of relevance here. I'm really only looking if we have a really bad day where only 10% of volume is to the upside, or if we have 90% to the upside. Just showing these really extremes of super bearishness or super bullishness, and we haven't hit this top black line or this bottom black line in a long time. So this one isn't really relevant. So overall, decent. We have a couple that are in good, one that's okay, and a few that aren't really telling us too much at the moment. The ultimate indicator is how many quality setups there are and whether trades are working. And we are starting to see, we've seen some quality setups, and we are starting to see more break to the upside as some of these stocks continue to run, especially in technology and the bigger cap names that would be more in the S&P 500. So sectors on the move, it continues to be technology and communication services. You can also keep an eye on consumer cyclicals. If you look at the chart, we have consumer cyclicals was the top last week, and communication services in there, technology up near the top. Over the last month, technology, communication services, the strongest performers. We can see consumer cyclicals coming in third there, and consumer cyclicals also third over the last 3 months. So it's lagging a little bit behind these others, but it's coming on strong more recently. So those would be, if you're a little pressed for time on your scanning, those would be the three sectors that I would zero in on. What I'm doing right now, well, as we discussed, I'm willing to deploy capital. As conditions continue to improve, I will approach having all my capital in the market. I'm not quite there yet. Maybe at about half of my capital is out there right now. And again, that's because we're in good conditions, but not fully ideal. And I'll deploy more if conditions continue to improve. As always, can always day trade. That's more of something that gives you some action every day. With this swing trading, we've had these periods of not trading, followed by periods of trading, followed by not trading, and that's more how swing trading goes because it's more dependent on overall market conditions, which can last for months. Whereas with day trading, you have conditions that last minutes. So you might have flat market conditions for 20 minutes, but then you get a trend, you can trade it, and so you get more action if you're trading for even half an hour, 2 hours, usually some action there. So it's just a different way of trading. So I like to have both. And you can also passively invest. I'm always doing this. While the market was dropping, I am buying the same ETFs over and over again. Not going to make as much in that account as I do in my swing trading account, but it's also, you don't have to think about much. You just buy the same index funds each month, ETFs, and you just hold them. You're going to average about 10% a year. That's the long-term average, maybe a little bit more, and because some of them have a little bit higher returns than the S&P 500. And That's what you just do, and it just compounds. And as the price drops, you add to it. As the price goes up, you add to it, and it's just a savings account on steroids. You can also check out that as well. So that is your stock market outlook for the week of June 5th. Happy trading out there.